Hello, welcome to another podcast by Touchstone Financial Education. My name is Elliot Cox, and here at Touchstone, we really enjoy educating people on the markets and investing. So for those of you who are brand new listeners, welcome and Happy New Year. And to my regulars, also Happy New Year and thank you. And again, a big shout out to all my international listeners. That list is growing day by day, and I am truly surprised and thankful that you've all taken time out to listen to my podcast. Now, a couple things. We have updated our website tremendously, and I say that in the most respectful way to all my help. It has been an uphill climb, but we are creating a more interactive website. So we've got market updates now. There's also a place on the website where you can fill out a form if you'd like to hear something or have questions and would love to have that addressed during a podcast. By all means, reach out to us, all right? And you can find us at touchstonefinancialeducation.com. Again, touchstonefinancialeducation.com. And like I said, there'll be market updates and some other things are coming as well. And hopefully this year, we'll be looking at some classes, so please stay tuned. Now, the reason for today's podcast is just kind of a review of what's gone on in the market the last 12 months. For those of you who've been listening to me since April, we've gone through the volatility, we've gone through the inflation, we've gone through the Federal Reserve interest rate hikes, so on and so forth, okay? And you know what? That is still impacting the markets today, all right? And we'll review a little bit of that, but I do cover that in previous podcasts like asset allocation and taxable investing, etc. But one of the things I'd like to get to first is there will be an increase in contribution limits to retirement plans here in the United States starting this year in 23. Okay, so on a 401k, a 403b, a 457, basically your employer-sponsored plan, the contribution limits are going to increase from $20,500 up to $22,500. All right, IRA or individual retirement accounts, those that you go out and do on your own, those dollar limits are going up from $6,000 to $6,500 for the year, starting this year. Now, there's also a catch-up provision. So those of you who are 50 and up, you get to put a little bit more money away because you are a little older. Congratulations. For an IRA, you could put away up to $7,500 per year. So that's basically a $1,000 catch-up there. And on the employer-sponsored plan, the 401k, the 457, etc., that's going to bump up to a dollar maximum of $30,000 a year. So those of you who are looking at your contributions or your 401ks overall, your retirement accounts, please keep that in mind. If there's room in your budget, by all means, try to increase the limits when you can. Again, $20,500 to $22,500 on the 401k, $6,000 to $6,500 on an IRA, the catch-up provision, $7,500 on an IRA, and $30,000 on that employer-sponsored plan. All right, now, back to the volatility in the markets, guys. You know what? It's going to be the same stuff, different day, as we have seen since last year. As long as the Fed is looming large over this market, this volatility will continue, okay? Now, does that mean that we head for the hills? Absolutely not. Do we cash out our positions, especially retirement accounts? Absolutely not. We hold the course. As a matter of fact, the younger we are, the more likely you are to benefit from this. So if you are aggressive and you are young in the markets and you have these funds inside your retirement plan that might have tech in the title or healthcare in the title, or even if you have total stock market funds, hold on. All right? It will turn around. This is probably the first time you've been through this, especially if you're under the age of 35. It does turn around. For those of you who are, let's say, 40 and up, I hope that you have the appropriate asset allocation and also hold the course in those retirement accounts. There's no need with a 20-year window to retirement, let's say, even a 10-year window to retirement, to go ahead and make adjustments to this particular market because this too shall pass. When will it pass? Hopefully when the Fed stops raising interest rates later this year. Now, we know we're going to have more interest rate hikes at a lower rate. So instead of 3/4 of a point, as they've done 4 of the last 5 meetings, they are now starting on a track of 0.5 point increases. And like they said, it might last a little bit longer, which means the volatility will last longer. okay? Stay the course in those retirement accounts. On your taxable investing, this is an opportunity to raise cash. Now, many of you have taken some money out of your brokerage account or your taxable investing account, whatever you want to call it, and have socked it away in high yield savings, CDs, I bonds, all the things that I've covered in previous consults. And that's all right. I mean, why not lock in 4% on some type of government bond fund while you're waiting for the markets to turn around? So this is just basically a way to go ahead and build or save cash, waiting for the opportunity. Again, when the Fed stops raising rates, that's when it looks like the markets will be turning around. Now, there's a catch in that, guys. Late last year, no, that's not true. Middle of last year, we got an indication that a recession would be looming, and that is the yield curve inversion. And what that means is that the 2-year Treasury, the 2-year government bond, is earning more than the 5-year and the 10-year. And this yield curve inversion, as it's called, usually signals a recession looming. And that's pretty much the consensus today. So we got that indicator last year. This yield curve inversion usually precedes a recession by 6 to 12 months. So the expectation is that here, probably before the end of the second quarter, we will be in a recession. Now, does that mean that the markets will pull back? Not necessarily. There's one thing that the markets do not like, absolutely do not like, that is uncertainty. But if we know something is coming, we can plan for it. If we know the Fed's going to slow down on raising rates, even if there is a recession, that still might present an opportunity for us to jump back in. I'm going to have to reference this one more time now. For those of you who are investing through your taxable accounts, still build cash, even though a recession is looming, you still could jump in. On your retirement accounts, keep it up. Increase those contributions where you can. Let this ride out. The further you are away from retirement, the more likely you will benefit from this 14, almost 15-month contraction in the market we've seen. And by the way, ladies and gentlemen, let's not forget that the previous 11 years were absolutely wonderful. So the market's going to do this from time to time. This doesn't mean we get scared. We jump out, especially depending on the type of investing we are doing. Retirement versus taxable. Now, you know what, guys? Today is the 2nd of January. We're going to kick this off this season with a short podcast, but I just wanted to review the markets, the volatility continuing, the increase in the limits. I wanted to say hello to those of you who've listened to me and have been waiting for the next podcast. Well, here it is. It's been about 3 weeks since I put one out. And just remember those limits on the 401k. The markets will continue to be volatile. Retirement's a little easier to plan for than taxable investing at this time. Again, got to stress this, raise some cash, take a look at your individual positions as well. You might want to buy some more of whatever you have that's down if it is good. And I've covered fundamentals and technical trading in other podcasts, so please look back to those to see what I'm talking about. And you know what? I'm going to continue with those into this year, probably in more detail, so stay tuned for that as well. Again, my name is Elliot Cox. We are Touchstone Financial Education, and we have been working really hard to improve the website to make it a more interactive platform. That will continue. If there's something you'd like to hear or have me discuss, by all means, reach out, fill out the form, and we will address it on the podcast. Thank you guys for listening, especially you tried and true listeners who've been with us through last year as we were growing, and also the international listeners. And to you that are new, thank you for finding me on Google or Apple or Stitcher or whatever you found me. And please continue to listen. Hopefully we'll put out some good stuff for you guys this year. I'd also like to mention that we're probably going to get started on our YouTube channel. So instead of just podcasts, we will have video. So you get to see what I look like as I do this. But I'm going to continue the podcast because I really enjoy that. Oh, one more thing. I also enjoy putting together the market updates on the website as well. And I'll be putting those out probably every week or two between the podcasts, just to give you guys a heads up as to what I see going on in the market that might be relevant to buy and hold strategies on investing like in our retirement accounts, or maybe even more aggressive strategies in and around trading, whether it be fundamentals or technicals we're using as indicators, or probably a combination of both. So thank you guys once again. This is a short one to kick the year off. I hope you guys have a great year. I hope you've enjoyed listening to these, and I hope you will continue to enjoy listening to these in the future. Thank you very much. Have a good day.